Hello and welcome to Star USA Training. Today is Tuesday, August 20th, and we're talking about USMCA, the United States Mexico Canada Free Trade Agreement. We do have a big group for today's session, and there's a great list of questions that came in already, so that's fantastic. We've already covered USMCA on some of our past webinars, and there's some great info on those. So I'm going to try and focus on USMCA from a slightly different angle today in order to give us a little more space for Q&A. And I'm hoping to focus in on the common scenarios and circumstances that arise during the normal course of business. And I want to give you all the space to ask the questions and get some pointers, some insights, some direction to help keep you moving forward. If you are interested in our past webinars, there are links on our website and in the slides that you'll get after this. So I'm really hoping that you all take advantage of the webinar question box there to ask your questions. And there is time carved out at the back end. There's every chance that we will run long on the time. So if you can't stick around, that's fine. But hopefully all of the questions will get answered during this one session. A word of caution as we jump in. While I am a licensed customs broker, nothing today should be construed as transacting customs business on behalf of you or your business. I want you to be in a position to solve the stuff yourselves, and I'm not allowed to tell you what the solution is for your specific items or your business. And lastly, this webinar is being recorded. The slides, materials, and recording will all be posted on our website, and we'll send an email to everyone that registered as soon as that recording goes up. So keep an eye out for that email sometime next week, probably. There is an NCBFAA code at the end of the webinar, and this session is eligible for 1 continuing education credit. And with all of that out of the way, let me do a quick introduction into who I am and who Star USA is. My name is Mike Easton. I am the president and general manager of Star USA. I've been in the industry for over 20 years, and I am a huge trade compliance nerd. People that know me can attest to that fact. Star USA provides international trade and compliance consulting, advice, training, and services across the entire spectrum of international trade compliance. So if it involves crossing borders, we've probably done it. We've probably been involved with it. We have excellent programs for handling your tariff classifications, your free trade agreement programs, CTPAT compliance, and lots of other things you can see on the slide here. If you want to learn more about us, you can find us at starusa.org or email us at hello@starusa.org. All right, and without further ado, here we go. Fundamentally, I want to convey that USMCA is a duty preference program. The whole point of it is to get a reduced or eliminated rate of duty on imports into a country. So with that in mind, there are 3 primary motivations. Either you want to pay less duty on your own imports, your customers in Canada or Mexico want to pay less duty on their imports from you, or your customer's customer in Canada or Mexico wants to pay less duty on their imports from your customer. Those are the primary driving forces behind wanting to do USMCA. Keep in mind, USMCA is not a legal requirement. The government never requires you to use MCA to import or export your goods. Participation is always voluntary in the eyes of the government. As far as your customers are concerned, it may not be as voluntary. They may require that the goods that they buy from you are eligible for USMCA. And in the same vein, you may require that your suppliers in Canada and Mexico are providing you with USMCA certification. So it's not a legal requirement, but it may be a business requirement. Records are everything. In the US, the record keeping requirement is 5 years. You need to keep your records. The first question that customs or any customs agency will ask is, show me your documents. And if you do not have documents, the presumption is that you are not eligible and you'll likely get a fine at the minimum. The USMCA only affects duties and fees, never taxes. When I say duties and fees, there is the duty at the tariff item level on the importation, and then US has a merchandise processing fee, MPF fee, that is applied to all imports unless it is eligible for a free trade agreement, and then the MPF is waived. The MPF has a minimum of, I think the statutory minimum is 25, but it's adjusted for inflation to like $28 now, somewhere in that ballpark. And it has a maximum of 500 and something right now. It changes all the time, and it's been increased for next year already. For Mexico, there is a customs fee called the DTA fee. which is 0.8% of the value of the goods. Even if the goods are duty-free coming into the US or Mexico, those fees will still apply. Recognizing that those fees are in play for your customers or for yourself helps to better understand the importance of having USMCA. In Canada, there is no fee on imports. It's just the duty and then the goods and services taxes in Canada, the GST. In Mexico, are VAT taxes applied to all imports, and in the US, there are no taxes applied to imports. Also keep in mind that USMCA has multilateral enforcement provisions. What that means is that it allows the customs administrations in Canada or Mexico to submit inquiries or come and audit US businesses that have created USMCA certifications. So it does create a little bit more exposure to your business, exposure to other regulatory agencies by participating in these free trade agreements. When we go through the material today, I want to talk about how the treaty does a lot more than just reduce dues and fees between those member countries, but we're not really going to unpack what that means in the context of the treaty. The treaty is much, much bigger than just duties and fees, but duties and fees are the incentive for businesses to participate. There's all kinds of intellectual property stuff. There's going to be all kinds of exemptions carved out for certain industries and promote certain economic benefits to the member countries. But the manifestation for those of us on the call today is primarily through one of these three vectors. When we go through the material today, you're not going to suddenly be able to do all of the USMCA requirements. It's not this isn't a magic bullet situation, but hopefully you'll understand some of what to do in various situations and then where to go to get more information or get help on these things. So with that in mind, we're going to walk through a series of common scenarios that occur and kind of look at how they work in practice. Generally speaking, most businesses are going to fall into all three camps that we look at today, all three of the scenarios that we're going to be running through. At some point or another during international business, you're going to be each one of these players. So it's important to understand the driving forces. And even if you never are one of these players, you're still going to be required to understand what your supply chain or your business partners are doing and what their needs are. So I want to walk through each one of these one by one. So scenario one, you are the importer. Your supplier is in Canada and Mexico, and you are the importer of record into the United States. Here's the easiest ways to comply. First, you request a certificate of origin or certification of origin from your supplier. You verify it's valid and eligible for the USMCA treatment, and you notify your customs entry broker prior to importation that the goods are eligible for USMCA, and you're done. That's kind of the scenario. But it is very, very common for problems to arise, and understanding what those problems might be and what to do in those scenarios is what we're going to look at. If you're lucky, it really is as simple as supplier gives you the certification of origin, it's valid on its face, your broker's been notified, the claim was filed on the entry without issue. That's the way it happens in a lot of scenarios. In fact, that's what should happen, and that is a very, very common occurrence. However, when it works, there's nothing to talk about really. So I'm not going to go into that. I want to talk to when problems arise, when things go wrong, what kinds of things are those supposed to be, and what are we supposed to do about them? So the first one we're going to talk about is the supplier doesn't understand the request. Then the supplier certificate is unacceptable for some reason. And lastly, the USMCA was not claimed before the entry was filed. So what can you do? Well, if your supplier does not understand your request, your paths to resolution here tend to revolve around education, either educating them on the importance of USMCA for your business, for the import that you're bringing in, either to, again, reduce your duties or to eliminate your PF fee, or because it's part of your supply chain and you need to have evidence for other purposes. But you need to equip them with enough information so that they can understand the importance to your business. If you don't take that step, they're much more likely to not give you the stuff that you need. In fact, supplier hesitance is quite common, sometimes even pushback. And that's fine. Communication is absolutely your friend here. You want to be talking it through with your supplier, helping them understand what you're after and why you need it. And then, hey, maybe everything just kind of works itself out. They either get on board, or in other scenarios, maybe you recognize that you don't need the information as strongly or as much as you thought you did, and you can overlook the request. If your supplier needs more information, you can direct them to the appropriate resources in their country. There's links on this slide here. Again, when you get the materials, you'll have access to where these take you, but Canada has published the CUSMA, the CUSMA text on their resources, and Mexico has published the TMEC resources on their government websites, just as the US has published it on ours. And lastly, you can direct them to inquire with their freight forwarder or their customs broker or some other resource to help them understand how to navigate USMCA from their end, from the supplier's end of the equation. So you really want to be working with your supplier to help them understand and pointing them in the right direction. But let's say that the supplier never gets on board and they never get you a certificate. What do you do? In that scenario, if you are not able to obtain a valid certification from your supplier, then the product in question is considered non-originating and you may not claim USMCA on the import. Do not pass go. Go ahead and pay the duties and then figure out what you're going to do about it next time and the time after, but you may not claim USMCA if you do not have the certification from your supplier. So let's say you got a certification and the certification is unacceptable for some reason. What you want to do is to work towards identifying the concern and then identify a path to solution. Is there a missing data point? Use Annex 5A as your reference material and ask the supplier to amend the certification in conformance with Annex 5A. We'll go through what Annex 5A means a little bit later on, but I want to put the citation in there so you know where to go to get the information on the data points that need to be on the certification. Perhaps there's a conflicting point of data. Maybe the HS is not the same as what they provided on the invoice, or not the same as what you've been declaring on your entries separately. So the task there will be to verify the classification and then communicate with the supplier about that discrepancy. Don't just pick something and move forward, have that conversation. And lastly, if you suspect a false claim, you need to confirm your suspicion and then either inform the supplier or CBP as appropriate, and do not file a claim. If you have suspicion that the claim is invalid for any reason, you are obligated not to claim USMCA on the import. You are not eligible for that duty-free treatment. When we talk about errors, I want to run through some of the common errors that I've seen on certifications and just to call them out for attention. Wrong blanket period. Certifications, they have a lot of cases the previous year's dates on them and are therefore no longer valid for this year's importations. So you need to get an updated certification from them. Incorrect info on the exporter, producer, or importer's details. In that case, you just communicate with the supplier and ask them to make the appropriate corrections and get an updated certification in time. The HS classification doesn't match what's expected. In that case, you do need to verify what the discrepancy is. If the HS is different on the certification than what you're using on the entry, that's going to be a red flag for customs. They will catch that and they will inquire about that. So you want to make sure that those are congruous with one another. The documentation has to match, kind of. If the origin on the USMCA certification is not US, Canada, or Mexico, you got a problem. I've seen people try to make USMCA certs with China as the country of origin. That's not how this game works. Generally speaking, you're going to have US, Canada, or Mexico, and that's it. There are some weird edge cases, but we're not going to go into those. So origin has to be sensible there. If the origin criterion listed is A on a manufactured item, origin criterion A, we'll dig into origin criterion kind of towards the end during the Q&A, but the one I see happen most is people put A as the criterion and the good is not wholly obtained or produced in the territory of one of the member countries. Wholly obtained or produced means that it is harvested from the earth. You can trace it back to being picked from a tree or mined out of the ground or fished out of the waters. If it's a manufactured item, you generally would not have origin criterion A. NAFTA changed the term preference criterion. USMCA uses origin criterion. So if you hear me tripping it up, it's because I cut my teeth on NAFTA. Additionally, the certifier's title is incongruent with someone who should be signing these certifications. Usually it indicates a lack of appropriate knowledge on USMCA when there's a signer that is maybe a sales representative or customer service rep, or it's the president of the company, or it's some other individual, shipping clerk. People that you would not normally expect to have knowledge. Doesn't mean they don't have knowledge, but it's a red flag that warrants further understanding. Reach out to the signer and ask them to verify what they know about USMCA, and just have them walk you through it. And they should be able to do that. And you are obligated to ensure that the certificate that you're receiving is valid. And lastly, if the certifier is not working for the exporter, if it's the producer, that's okay, although that's not particularly standard. And it would lead me to ask a few questions. But if it's neither the producer nor the exporter, to your knowledge, then it's definitely a red flag that there's this other person or other party involved that is signing a certification that is not either the exporter or the producer. So keep an eye out for those common errors. Okay, lastly, if the USMCA wasn't claimed before the entry was filed, the goods came across the border and they were entered as dutiable at the time of entry. And then we find out after the fact that the goods were eligible for USMCA treatment and duty-free treatment. First off, you want to be verifying the claims that your business is making. The best conduit for this that every importer has access to are the ACE reports, the automated commercial environment. If you don't have access to ACE reports, I highly recommend looking into getting access to those reports. It gives you a window into understanding what customs knows about your business, at least some version of that. If you cannot get your ACE reports for whatever reason, and if you need help with signing up for ACE, you can reach out to us. We've done it 100 times or more, and we're familiar with navigating it. And we're familiar with pulling the reports, which is not a very simple process. But let's assume that you can't get the ACE reports. Your broker may be able to get you reports, or several of your brokers may be able to provide you with data. And lastly, you can submit a request to customs and they will give you a download of your data on CD. I think they still do it on CDs. But you want to be using those reports to track your entries, both the ones with and without USMCA claims. In fact, having a solid import activity audit program or entry review program is as important as having your USMCA program in place. If you're not checking your entries for the claims that have been made or the claims that have not been made, you're basically trusting people to do things right every time. And I'm not sure if you've all met people, but all of the people that I've met are human, and mistakes are part of the game. In fact, some people only make mistakes. We really should be checking. It's not from a, I don't want to be too pessimistic here, but people are people. And it's very easy when processing a lot of paperwork and working through a lot of really wild scenarios in some cases to misunderstand the information that you're being given, or to not include a piece of data on an invoice, or to not include a document with the shipment. Point is, it's not enough to assume that it's going correctly every time, and you should have a program that looks at your entry activity and identifies any discrepancies. Do it for FTA claims and USMCA claims for sure, because there's money on the table there, but you also have an obligation to ensure the rest of your imports are correct. So you want to be looking for other red flags. Don't just focus on duty. In fact, customs doesn't really love it when you only focus on duty, and they'll have enough data to determine whether you're only looking for money. But let's say you find an error with a USMCA claim and the claim was not made, but it should have been. You have the certification in hand and you're ready to get the money back. What do? Well, the treaty allows for claims to be filed up to 1 year after the date of importation. So as long as the time period has not elapsed, what you do is you can contact your entry broker, provide them with whatever documentation is necessary to demonstrate that the goods are eligible for USMCA. It's going to start with a certification of the document itself, but it might also be additional statements that your broker might need or that customs might need. And then you ask them to file what's called a 520D. The 520D is based on 19 USC 1520D, which is the provision for basically post-importation recovery of duty through free trade agreements. It's a relatively straightforward process to submit these 520Ds from a broker's perspective. It's not entirely complex, as long as they have all of the substantiating documents. There might be a charge for the broker to do that, but typically if you're recovering duty, it's going to be offset well enough, and you go from there. So once you've made those corrections, you should be able to get the duty back. If it's been more than 1 year, I'm sorry, the statute has expired. You may not recover that duty, and you kind of have to eat the loss. I should quickly address before we move on. If you find that you made a USMCA claim in error, so the claim was made on the import, but the goods are non-qualifying and you do not have the documentation to back it up, you must file a correction of that claim and pay back any duties that were owed. If you discover it and make the correction yourself, then you will not be subject to penalties. But if customs discovers it, then you will be subject to potential penalties. Okay, so that was scenario one where you were the importer. That kind of walks through how to get the certification from your supplier and make the claim on the entry and correct any mistakes and claims that were made on the entry. But now let's flip it. Instead of being the importer, you're going to be the exporter in this scenario. And again, almost every business that I've worked with is sometimes the importer and sometimes the exporter. Sometimes you're also the producer, and we'll talk about that in the next scenario, but for now, you're just the exporter. So that means that you're the one providing the certification to the importer. You're the exporter, you're not the producer. Your customer is in Canada or Mexico. They have requested from you a USMCA, a CUSMA, or a TMEC certification. In the US, we call it USMCA. In Canada, they call it CUSMA. And in Mexico, they call it TMEC. Be familiar with those different terms because your customers are going to expect you to know what they're talking about. Here's the easiest ways to comply. First, you obtain a supplier certification, and then you prepare the exporter certification. So we'll take a look at what that means. A supplier certification is documentation given to you by your supplier, traceable back in sequence to the original producer of the good. As the exporter, you're using the supplier certification to generate your own exporter certification that will be used by the importer. And that completes that certification chain. I'm calling it a certification chain for the purposes of this webinar because the producer issues it, the exporter creates their own, and then the importer uses it at the time of importation. Supplier certifications, even if they're not meant for the actual exportation, supplier certifications are going to contain all of the same essential data elements that are spelled out in Annex 5A. Generally, supplier certifications are not used for export transactions. So be aware of what the difference means. The point of what I really want to convey here is that USMCA certification works as a series of certifications tracing back to the original manufacturer of the good. That first certification in the chain is commonly prepared by the producer, and the final one is commonly prepared by the exporter to be used by the importer. The reason you shouldn't use a producer or supplier certification for the export is that there are often very valid business reasons not to expose the producer's identity directly to your customer. Instead, on an exporter certification, it's normal to use the words available to the customs authorities upon request or something to that effect. I'll go to the next slide. Additionally, the producer likely does not know the place of export, which is supposed to be indicated on the exporter field of the cert, and they also don't often know the importer's information. So it's difficult for the producer to produce a fully valid and usable exporter certification, and generally the exporter should be producing that document. Okay, so when you've gotten your supplier's certification and now you're tasked with preparing the exporter certification, you need to focus in on Annex 5A of Chapter 5 of the USMCA. This is going to spell out the 9 data elements that you need to include on the certification. One of the key changes from NAFTA to USMCA is Form 434 no longer exists. It is not a requirement. You do not need to use a specific format for creating the USMCA certification. You can use any piece of paper you want. You can include all the data elements onto an invoice if you so chose. Most people in the industry have chosen to just create their own documents that are substantially similar to the Form 434, maybe a little bit less weighty, a little bit more flexible for containing all the information that need to be on there. But as the preparer and the certifier, you should be accurately reflecting the type of certification that you're providing. So it would be an exporter certification. That's the one that you would typically pick as the preparer type. In fact, if there are importer certifications, that's generally a red flag, but the USMCA does allow for importers to create their own certification and base an import claim on their own certificate. It's not common, but it can happen in specific circumstances. If you're the exporter, you must be providing the exporter info. This is only allowed to be unknown. The exporter, this is bullet point 3 here. You're only allowed to provide the word unknown in the exporter's information if you are the producer. If you are the exporter, then you must provide your info. If you are the exporter, you do not need to provide the producer's information. Available upon request by the import authorities as directed in 5A is a perfectly appropriate thing to include on this field. Producers need to include their own info, but if they are not the exporter, the exporter does not need to include the producer's info on the certification that is used by the importer. If you're the exporter, you must provide the importer's info, although you can elect to put something like various in this field instead, but I would advise against that generally. Certifications should be issued to a specific company that you are transacting business with, and you don't want claims to be made by any possible company that gets a hold of the certification. So if you prepare a certification as an exporter with the importer listed as various, that document can be used by any importer in the territory if they have a copy of it. And it would be considered valid, and you would be effectively exposed to any risks that might come with. The last 4 data elements here, the description and HS classification to 6 digits. If you're the exporter, you should be relying on the HS classification given to you by the producer on the supplier certification or on the producer certification. You only need 6 digits on the USMCA certification, so that's all that you should provide. Giving more than that makes it more difficult for everyone involved to remain compliant, and 5A specifies to the 6-digit level, so that's what you should be putting on a certification. The origin criteria are spelled out in Article 4.2. Again, I'll tackle those during the Q&A portion in a little bit more detail, but you would indicate A, B, C, or D typically here, D1, 2, 3, or yeah, D1, 2, or 3. But yeah, you would include a letter there for the origin criterion. And then the blanket period, which can be up to 12 months. The blanket period, again, is 12 months max. It's perfectly acceptable to limit the duration to less than 12 months. Like maybe you buy from multiple suppliers and you want to limit the certification to one specific invoice or shipment. And you could do that through the blanket period, but it's more common to specify shipment identification numbers in the description from box 6 up here or bullet point 6. Typically, it's very common to have 1 calendar year as the blanket period. The importer should be importing the goods during that blanket period. If they are importing the goods outside of that blanket period, then the certification that they're using is technically not valid at the time of importation, so they should be getting an updated certification with the correct time frame that covers the actual date of import. Hopefully that makes sense. And lastly, you need to include an authorized signature and date, including the legal text from Annex 5A saying, I certify that the goods described in this document qualify as originating, and the information contained in this document is true and accurate. I assume responsibility for proving such representations and agree to maintain and present upon request or to make available during a verification visit documentation necessary to support this certification. That is a legal statement that the signer of the certification is agreeing to, that is legally binding. And it has to be there in order for the certification to be considered valid. If it is not there, then the certification is not valid. Okay, the last scenario we're going to look at before we start wrapping up and heading into questions, and I know there are several questions coming in, and that's fantastic, and we'll look at those. All right, last scenario. We looked at being the importer, we looked at being the exporter. Now we're going to look at being the producer. You and your customer are both located in the United States in this scenario, but your customer's customer is located in Mexico or Canada. So you're neither the importer nor the exporter. In fact, you're not even involved in the international transaction whatsoever, but you are still an essential piece of this certification chain as the producer. Remember when I said earlier that certifications are traceable back to the producer? That makes the producer the first link in this chain. And even though you're not directly involved in those international steps, you still have a customer that is asking for a certification from you directly or indirectly. They either need it because as the producer, you're an essential part of that supply chain for them, and they are either exporting your good in its current condition, or they're using your good in the manufacture of additional goods, and they need to know the certification status, the HS classification, and the origin of the good so that they can incorporate that into their own qualification process. So here's the easiest ways to comply. You're going to conduct your USMCA qualification, and then you're going to provide a producer certification to your customer. This is the hard part of the USMCA. The importer part is arguably the easiest, where you're just getting a certification from the exporter. The exporter part can be a little bit more involved, but it's still pretty lightweight. You're getting certifications from your producers and your suppliers, and you're preparing a certification for the importer. As the producer, you need to undertake the qualification process of the goods, and you also need to provide that certification to the exporter. So let's take a look at what qualification means in this context. So there are two basic steps, and I am boiling this down into the simplest way of explaining it as I am equipped to do. I'm sure that there are people that are better at explaining it than I am, but we're going to take a stab at boiling it down into these two steps. Step one, determine the HS classification. Qualifying your goods requires understanding of several key concepts, but it starts with the HS classification. The USMCA rules are very closely tied to that HS classification. If you don't know how to properly classify your goods under the harmonized system, the HS, then please feel free to send us an email after the session to train@starusa.org, and we'll send you to our classification webinar that we did earlier this year, or we can point you to some useful resources, or you can hire us and we'll do the classification for you. But it has to be correct. The classification under the harmonized system, accepted by the WTO and enforced in basically every major country in the world, is a big deal. But it's out of the scope for looking too deeply into how to do that today. Just know that you have to have the classification on hand. And then once you have the classification, you apply the USMCA rule of origin to your good. Those rules of origin are spelled out both in Chapter 4 of the USMCA, I think it's Annex 4A, which we'll kind of break down here in a moment, and General Note 11 of the Harmonized Tariff Schedule of the United States, the HTSUS. All of the rules of origin are in both of those places, and they're the same rules. So, conducting USMCA qualification. There are three basic methods. There are the USMCA special rules, there's tariff shift, and there's regional value content. We're going to walk through those in some level of detail, but it's not going to be enough to master these skills. I just want you to give you the framework for how they work. So the USMCA special rules are identified within the text of the USMCA, and they often start at the beginning of select sections of the USMCA rules of origin. For example, there's the de minimis rule in Article 4.12. Again, that's in Chapter 4 of the USMCA. There are notes at the start of Chapter 27, and then notes at the start of Section 6 and Section 7. Those are the chemical rules or the plastics rules that apply to chemical mixtures and things like that. And then there are also notes at the start of Section 11. And there are other notes interspersed. There are automotive rules, there are textile rules. There are other considerations that need to be weighed, and you need to understand that these special rules exist, and you should be reading these. In fact, these USMCA rules are largely new from NAFTA, and I can't really overstress how important it is not to just look at the HS specific rules that we'll talk about in a moment. You have to scroll up to the chapter and the section notes. You have to scroll down to the special appendices that exist. You have to know what the rules are for your products to make sure that there isn't a special rule that either grants you some sort of advantage or some sort of disadvantage when qualifying your goods. So now we're going to take a brief look at tariff shift and the concept of tariff shift. So special rules exist, but one of the standard rules that we deal with frequently throughout the entirety of the USMCA rules of origin is tariff shift. In a nutshell, tariff shift is basically transitioning from one article in the HS to another article in the HS. And it typically occurs at a specific level of the classification, either the chapter level, the heading level, or the subheading level. Some examples include from 7201, it will say the phrase, a change to heading 7201 from any other chapter. That's a chapter shift. Contrast that against 1704, where the rule is a change to heading 1704 from any other heading. That's a heading shift. And you'll see how the from any other is important there. And then lastly, we have 320650, which is a change to subheading 320650 from any other subheading. That's a subheading shift. So you've got basically two options with the tariff shift rule. Again, you're trying to answer the question of whether the good is sufficiently different from its non-originating components. So either the non-originating components meet the shift, or the components that do not meet the shift are originating. You're only trying to shift the non-originating components. But if you have only originating components used in the production of your good, then your subsequent good is going to qualify because it can't transform from an originating good into a non-originating good without any non-originating input. I hope that makes sense. If the non-originating components do not meet the shift, then the finished good does not qualify. I'll say that again. If the non-originating components do not meet the shift, the finished product does not qualify. If the components that do not meet the shift are originating, the finished product does qualify. And lastly, if the non-originating components do meet the shift, then the finished good does qualify. Tariff shift is about becoming a different article. So let's take a look at regional value content. Regional value content is a comparison calculation of the value of originating material against the value of non-originating material. RVC is answering the question, it's abbreviated as RVC. Regional value content answers the question of whether enough originating value has been added in the territories or if not enough originating value has been added. If the regional value content is above the required thresholds, then the good does qualify. If the RVC is below the required thresholds, then the good does not qualify. The normal threshold for RVC is 60% when using the transaction value method, or 50% when using the net cost method, but there are different targets depending on your rule of origin. 60% transaction value and 50% net cost are far and away the most common throughout the entirety of the tariff, and you can fall back to those in a couple of different scenarios, but certain goods have different standards. And those are all kind of identified in Annex 4B of the USMCA. So there's two formulas for calculating this. These are relatively straightforward formulas from a math perspective. The transaction value method has you take the transaction value of the good, subtract out the non-originating materials, the value of non-originating materials, and divide that back into the transaction value of the good. The net cost method has you doing basically the same thing. You take the net cost of the goods, subtract out the value of non-originating materials, and divide that into the net cost of the good. And that formula will give you a value of originating materials represented as a percentage. You multiply by 100%. So hopefully that you just have the correct transaction value or the correct net cost for your good. You've identified all the non-originating materials, divide those in, and you come out with a number that is either above or below the threshold specified in the rule of origin. The hard part in all of this is really determining what counts as originating and what counts as non-originating. And we'll kind of circle back to that later towards the end here. So how do you know when to use tariff shift or RVC? It's because the rule of origin from the HS classification that you had is going to tell you and is spelled out somewhere in Chapter 4, typically Annex 4B of the USMCA. You must look up which rule applies. You cannot choose which rule to use. You can choose which calculation method to use if you have an RVC rule. You can choose to use net cost. You can choose to use transaction value in certain circumstances, but you cannot choose whether it's an RVC rule, a tariff shift rule, or a special rule that you're using. So let's say you've qualified your good, you've done all the calculations, you've examined the tariff shift, and you've decided that the good does qualify. Then you are ready to produce the producer certification, and you would give that to your customer, who is the exporter in this scenario. The producer certifications are going to conform to the same data elements in Annex 5A that we looked at just a few minutes ago. And you can refer back to that list of 9 data elements there, with the limitations that the producer isn't going to know necessarily the exporter address, nor who the importer is. Producers should advise customers to complete their own exporter certification in lieu of providing the producer certification to the importer. Again, there are valid business reasons why exporters would not want to expose the producer to their customer. And there's every chance that if the customer, again, let's say the customer's in Canada or Mexico, if they know who the original producer is, they might try to buy the goods directly from the producer, cut out the middleman exporter. And again, producer certifications are the first link in the certification chain, and producers share the same obligations and responsibilities as the exporters and the importers under the USMCA. If an importer makes a claim based on an exporter certification and the exporter made their certification based on the producer's certification, all three have shared responsibility in USMCA under the laws, meaning any one of the customs agencies can inquire against any one of those parties. So a Mexican importer may get questions from their own government, Mexican SAT, and they would produce the exporter certification. Mexico SAT would then talk to the exporter, usually through the form of an inquiry, and the exporter would produce the certification they got from the producer, and then the Mexican SAT would then go to the producer and ask for evidence of the qualification of the goods. So everyone is responsible there. If you cannot determine, so this is assuming that the goods did qualify, we went through the qualification and they did qualify. If you cannot determine that the good satisfies the rule of origin, then the good is considered to be non-originating. You cannot prepare a producer certification on that good if you do not have evidence that the good meets the rule of origin. You should be explicitly telling your customer via a separate document what the HS is, what the country of origin is, and then provide them with a written statement that says this good does not qualify as originating under the USMCA. The country of origin can be US, but the good does not qualify as originating under USMCA. Say those words directly to your customers so that there is no confusion over what you're providing them. They are still going to want the country of origin and the HS classification for their own purposes, either for the direct export of the goods or for incorporation into the goods that they are manufacturing. So they'll still need that information, and they'll need that certification statement or that statement that the goods do not qualify as originating. Hopefully that all makes sense, and I wanted to hit this concept of originating as cleanly as possible here. So what does it mean to be originating? Both tariff shift and regional value content rely on understanding and applying that concept of origination. To be originating means the goods satisfy the requirements of the USMCA. That means they have met all applicable rules of origin from Annex 4B. Whatever is spelled out in the text of the agreement, these goods have met all of those standards, and therefore they are eligible under USMCA and they are said to be originating. So for the tariff shift rules, all the non-originating materials must meet the shift, and the originating materials can ignore the shift entirely. But the non-originating materials must meet the shift when there is a tariff shift rule in play. Under regional value content rules, the value of non-originating materials must be below the required thresholds. The good must contain sufficient value from originating materials in order to be considered originating under the USMCA. All of the certifiers, the importers, the exporters, and the producers, are responsible for demonstrating the origination status of a good through a certification that conforms with Annex 5A. If you do not have a certification that conforms with Annex 5A, particularly that number 9, that text at the end, then you would not treat those goods as originating. Without a valid certification, all goods are presumed to be non-originating, irrespective of country of origin. You can absolutely have country of origin US for goods that do not qualify as originating under USMCA. USMCA originating is not the same as origin US, and origin US and USMCA originating are not the same as made in USA. All three of those are very different standards, and whether or not a good qualifies for any or all three or two of the three is dependent on the rules within the laws that cover those things. Also keep in mind that originating status is only valid for up to 1 year at a time. And sometimes it's only valid for one specific shipment, so you need to keep that in mind as well. So that means you need to determine the originating status of the goods at least annually. The goods from your suppliers, the goods from your exporters, the goods from your importers, the goods that you manufacture, you need to do that all annually because that is the limit on how long they are valid for. That concludes the content portion. We discussed motivations for using MCA, applying USMCA as importer, exporter, producer, navigating that certification chain, qualification methods under 4B, certification data elements from 5A, and then originating under USMCA. Your NCBFAA credit is here on the screen. Thank you for your time. If you have questions, feel free to email us at train@startusa.org or at hello@startusa.org. We'd be happy to help you out. You will be getting an email with the slides and the NCBFAA code and the link to the recording. So good luck, everyone. Thank you.